The Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. Hi everyone. On today's episode, I'm interviewing Nicholas Ward, a young investor who writes dividend growth-focused investment analysis on Seeking Alpha and the Income Minded Millenial channel on themaven.net. Nick manages a portfolio of high-quality stocks that includes both classic dividend growth stocks, as well as a handful of more speculative growth securities. In this episode, we discuss Nick's investment philosophy, where he's seeing opportunities in today's market, and how individual investors can position themselves to achieve above-average total returns. Stay tuned for more. Well, Nick, I just wanted to start off by thanking you for being a guest on the Sure Investing Podcast today.
Yeah, no, thanks for being here. You know, it's always nice to mix it up and do a little audio instead of typing away all day.
Yeah, so I mean, with that in mind, I think our listeners would be interested to hear a little bit about who you are and what your place is in the world of investing.
Well, in the grand scheme of things, I don't know if I have much of a place. I'm just a Main Street, everyday average Joe type of guy who kind of realized he really liked portfolio management and following the stock market. And over the years, I've written for various publications as probably more of a financial blogger than anything else. But I've sort of transitioned into a full-time portfolio manager, and I just recently sort of opened up my own website, Income Minded Millenial, where I'm sort of, I guess, have more freedom on what I share over there. So I'm excited to sort of make that transition in 2018.
Yeah, that does sound exciting. For anyone listening on our website, we'll toss in a link to Nick's website down in the description. Just turning back the clock a little bit, Nick, when was it that you started to really become interested in investing? And later on, when was it that you decided that it might be something you want to pursue with your career?
I became interested, unfortunately, after I graduated from college. And actually, I'll give my University of Virginia Cavaliers a shout out today. We were just ranked the #1 team in the nation for the AP basketball poll, so I'm excited about that. But I studied English and studio art when I was a student there. I really had no interest in the market or finances or really money at all. I graduated. I wasn't getting paid as much as I might have liked because I pursued the arts path rather than a more practical degree. And so ever since then, I've been doing everything I can to turn what I make into more money in the market.
And was there any kind of, did you read a book that made you start to be interested in investing, or was there one kind of experience that you say turned you from being interested in the arts part of academics to more being interested in investing in finances?
I think it was more of necessity than anything else. I looked at what my paychecks were and realized I wasn't going to meet my long-term goals if I didn't do something to augment them. So that led me to the market. You always hear about the stock market as a means of wealth creation. Once I got there, I kind of found seekingalpha.com, and I read a lot of work there for a while and then became a contributor there and then grew alongside many others in the dividend growth investing community that has developed there over the years. And then I guess I haven't really read a lot of books, but I have a big asset that's helped me a lot has been the Berkshire Hathaway annual shareholder letters. I've read all of those several times, dating back, I forget the first one. I think it's in the 70s or 80s. And there's a lot of great information that Mr. Buffett shares in his annual letters.
I would agree with that wholeheartedly. I mean, probably the best business book I've ever read is The Essays of Warren Buffett, which is just a compilation of those annual reports that are pieced together in a way that kind of makes a logical progression through various themes.
I've liked, Peter Lynch. I've read some things over the years. It's, you hear a quote someplace and you want to hear where it comes from. And I think that's kind of where that goes. I've read Benjamin Graham, The Intelligent Investor, because that was such a big influence on Warren Buffett. But I kind of had to admit, a lot of this financial writing is a little bit dry for my taste. So unfortunately, I don't have a huge appetite for reading that stuff. I'd rather read a science fiction book or something like that.
Yeah, I mean, I resonate with you there too. I think that I was late to read The Intelligent Investor. It was like far from the first book I read about finance or investing. And given all the hype that it receives in the media and, Mr. Buffett's high praise of the book, I really expected it to be better than it was.
Yeah, I mean, certain chapters I think really resonated with me. I learned a lot about margin of safety. And that's kind of carried over into my personal investment strategy a lot as I pursue passive income, but my everything is on such a strong valuation foundation for me, I think, which is a little bit different from a lot of other dividend growth investors who seem to be interested in yield first and foremost. But yeah, no, I agree. That wasn't, I probably won't read that book again. I'm okay with that.
You touched a little bit there about your personal investment strategy. Could you provide more detail and more color about what you look for when making investments and what you think are the most important characteristics of a good long-term hold?
Yeah. No, I'm a younger investor. I just turned 28. So I prioritize growth a lot and not necessarily like hyper Tesla momentum type of growth. I do want to see a long-term upward trajectory on the top line, which to me is sort of the baseline for sustainable dividend growth long-term. It's, financial engineering and things like this can make a dividend sustainable for a certain amount of time without growth. But at the end of the day, I want to see companies that are taking market share, that are being innovative, that are being disruptive.
Yeah, definitely. Is there any standout investments in today's market that you think are exhibiting those characteristics?
There's a ton of companies that offer great growth. The problem is finding them at attractive valuations. I'm sure, as you know, that just the market's willing to pay up for growth, and that maybe that'll change as interest rates rise, because that should theoretically put less of a premium on forward growth estimates. But I'm just looking. I put together a list of stocks that I'm sort of looking at the moment after this sell-off. Obviously, a lot of the FANG type tech names are attractive. They're becoming attractive anyway, as Facebook and Alphabet specifically, even though they don't pay a dividend. I've written about that. But I already have such big positions in those names, I'm sort of hesitant to add to them. A company in the DGI space that I'm looking at right now that is actually Comcast. I own Comcast already. I wouldn't mind adding to that position. It's well diversified in the media space, and it offers some of the best dividend growth out there. I think it just recently increased its dividend another 20%.
20% growth over even a short to medium period of time. That amounts to some really impressive compounding.
Yeah, I think it's got like a 2% yield right now, but like you said, if it's able to give 15-20% growth for 5 years, your yield on cost becomes high really quick. With that said, I'm not a big yield on cost fan as a metric of ownership or why you should hold on to a stock, but it is fun to look at that and to see what your money's done for you over the years.
Yeah, for me, I share the same perspective as you, where yield on cost doesn't really matter, because if your yield on cost is high but your current yield is low, you can always sell, take your profits, and invest them somewhere to make more money.
Yeah, and I've had that conversation too many times to count, and a lot of income-oriented investors hate selling because then you end up having to pay taxes unless it's in a retirement account or something like that. But they really harp on their yield on cost. I try to, if I can sell a company right now, even my yield on cost is 10%, but it's only yielding 2%, and I can buy a company yielding 3%. I'm still making more money next dividend payment that way.
Yeah, definitely. And you mentioned that you don't place too much emphasis on current yield. Are there any examples of attractive low yield dividend stocks out there right now that stand out to you?
Yeah, there are. Nvidia's really shining for me right now. And you talk about low yield, that's like a 25 basis points. So that's not much of a yield at all, but that's definitely more of a speculative growth stock for me at this point. But I thought their last quarter was fantastic, and the stock, I think after its performance today, it might even be down since then. If not, it hasn't gone up much. And then, you have the Visas and the MasterCards, the Disneys, the Nikes. You have a lot of the popular ones. And, the valuations, Disney's valuation is interesting to me at this point in time, but it's my second largest holding, and it is having some issues that it needs to resolve. So I'm a little hesitant to sort of push that exposure up much. I think it's at like 4.5% of my portfolio right now, and that's kind of pushing the upper limits for me.
Yeah, definitely. Are you talking about ESPN issues?
Yeah, ESPN, cord cutting. The studio and the parks are great. It's just the whole media space is interesting. I cover it a lot. I own just about every company in the media space. I sold Time Warner recently, but I have a bunch of AT&T, and I hope that acquisition goes through, and then I'll end up having exposure to HBO and the Warner family of networks and the studio Paramount here shortly. But, everything but Netflix. Netflix, I just can't justify the valuation. I think it's a great company. I think it's got a lot of pricing power, which is something that I really look for when choosing investments. But I can't come to terms. Maybe it will earn $10 here in another 5 years, and then everything will be okay. But if that doesn't happen, I worry about multiple contraction there. But I'm really looking forward to Disney's over the top, the stuff they're coming out soon. ESPN's the sports one's coming out this year, and then they'll do the Disney specific one next year, I think. And then they have Hulu. So I'm interested to see how all the chips fall in the media space.
One of the things that I find very interesting about Disney's new over-the-top strategy is whether or not it's going to cannibalize Hulu, which they own a pretty sizable stake in. What are your thoughts on that?
Well, I don't think the sports one, I don't think will have much impact on Hulu because I'm not a Hulu customer, but I don't, and you can correct me if I'm wrong, they don't offer the sports on that, do they?
Not that I'm aware of, but like you, I'm not a customer either, so. I
think they're going after a different market there. And I think with the Fox acquisition, if that goes through, they'll end up owning, I think 40 or 45% of Hulu. So that will be a big part of Disney moving forward, unless they're forced to divest it by regulators, which is rumors that I've heard. But I like them having that because if they do the Disney family oriented over the top thing with the superhero movies and the animated flicks and stuff like that, you're not going to be able to put a lot of the FX content and Deadpool and cuss words and things like that. You don't want to have that on a Disney children's over the top. So I think they're going to need another avenue to distribute their content. So I actually like having the three-pronged attack with ESPN for the sports fans, the children's stuff for the families with the young children, and then Hulu for adults.
That's some very interesting perspective. I hadn't thought about the whole children's content versus adult content before, but you make a very good point with that.
Yeah, and then Fox Studios puts out a ton of movies every year, and it'll be interesting to see because Disney only goes for blockbuster films, and that's why they're the most profitable studio in the world. But I'd hate to see a lot of the more drama and just a lot of the art stuff that Fox does get sort of cut away by profit-driven Disney. But a lot of those films just wouldn't be appropriate for a family over-the-top platform or for children. So, like I said, I think they're definitely going to need to figure out something else to do, or they can just sell it all to Netflix. But I think they're at the point where they don't really want to feed that beast any longer.
Yeah, definitely. I mean, it's clear from this short conversation that you like Disney. You think they're a good business. You mentioned that they're your second largest position. What are the things that you like about Disney as a business that you think people can generalize to other investment opportunities?
I think, you're getting decent growth. That's slowed down recently, but in the past, you're getting 10% top and bottom line growth, and you're paying, 17 to 20 times for it. So that's not a bad price to growth ratio there. So I think you can, look at that. I'd much rather pay a little bit more for a company growing 10% a year than to pay for a company that's not growing at all, which is the case with a lot of the consumer staples that we're seeing today. But just lessons that you can learn. And I should have seen this before. I wish I totally underestimated the cord cutting phenomena. And if I would have gotten that right, then I probably would have sold some of my shares a few years back. Something I've learned personally is a lot, you get the idea that a company is a core position in your portfolio and therefore you don't want to sell it. But I think sometimes that's to my detriment and to anybody's detriment. You always hear about buy and hold investing being the best way to go about it. But sometimes when something you own is getting disrupted, I think it probably makes sense to sort of cut back on that exposure. And if you lose money, if they end up doing really well and you lose out with the opportunity cost, it is what it is. I should have probably protected some of my capital there because Disney's been a underperformer for me for a few years now, and that since it's such a big position for me, that's sort of put a little damper on my overall returns.
Disney's your second largest position. What is your largest?
Apple, which has done really well. So I think, that sort of balanced things out there.
And how much larger would your Apple stake be than your Disney stake in terms of percentages?
Disney was my number one stake probably a year or so ago. Apple's recent performance has allowed it to hop over it. I think Apple's like 5.5%, 6%, and Disney's like 4.5%, 5% right now.
And how many stocks would your total overall investment portfolio contain?
It's right around 75, I think. A full position for me is right around in the 1.5% to 2% weighting. My top positions are all overweight. I think my top 7 or 8 are probably in the 2.5% range or above. And I have a ton of positions that are 0.5% or less than 1% because I average into position slowly. So I'll pick a price target that I think is a good value and I'll buy it. But then if it doesn't continue to go down to my other price targets, I end up just never filling out that position, which isn't the end of the world. It means that I'm making money, but it also means that I have probably more positions than I planned on.
And would you say that your 75-ish current portfolio diversification, is that your optimal level, or would you like to see yourself owning less or more stocks?
I don't have much of a preference. I focus on value and just kind of let the market come to me. So yeah, I didn't set out with a certain number in mind. Technically I talk about a 2% full position weight. That would theoretically mean I hold 50 companies, but it doesn't bother me holding more or less. I just over the years I've learned just to sell things when they're really high and to buy things when they're really low. And I'm not living off of my passive income, so I don't have to worry about how much I get in January as opposed to February. I take the dividends when they come and reinvest them when they come. So there'll probably be a time when I have to be more strategic about my holdings from that perspective. But right now, I'm just accumulating high quality assets when I see them trading at attractive valuations.
Have you ever invested on margin or thought about investing on margin?
I thought about it from time to time, more about shorting things. Every now and then I'll read something or see something and I'll just be certain that something is a short. But on principle, I've never done that. I guess it's the risk reward of limiting your upside while having infinite downside is it's hard to kind of wrap my head around that. And generally I don't like having debt. I've taken a lot of steps. I don't have any credit card debt. I use a credit card for the rewards, but I pay that off every month. I'm student debt free myself. My wife is actually in graduate school right now, and we're thinking about taking on some debt for that. But I think it'll be a good investment. But in general, I like to be as debt free as I can. My mortgage is the only exception.
I think that's generally a wise policy for about 99.9% of investors. And I think the only exceptions are when people can get some kind of unique form of leverage that is non-callable and charges a very low interest rate, almost like insurance float.
Yeah, I've seen just too many horror stories, and you saw it last week in the market. I mean, the reason I think a lot of the volatility had was because of margin calls on that inverse VIX fund, and too many bad things can happen unexpectedly, and it just isn't worth the risk. I own a lot of growth companies, but I consider myself to be pretty conservative, and I know what my goals are long term. I'm not. If I ever become a billionaire or something, that'd be great, but I'm sure that won't happen the way that I manage the money. So, and I'm okay with that as long as I'm able to reach the freedom on the timetable that I have.
Yeah, definitely. I just want to go back and talk a little bit more about your due diligence process when you buy stocks. Do you ever use anything like the dividend discount model as a valuation technique?
I don't use that. I'm not a fan of the dividend discount model because it relies too heavily on estimated regular dividend increase rates of return. I do a lot of work myself on determining where I think dividend increases will be in the future based upon earnings and earnings estimates, and I do factor that into my due diligence. But a lot of the sort of formulas that I see, I guess, and like I said, I studied art. I haven't taken a math class since I was a sophomore in high school. I've just never been all that attracted to numbers and statistics. So for me, it's a lot more of an art than a science. Obviously, I need to pay attention to the numbers, and I do in the markets, but I don't use a lot of the formulas that I see other people using.
I think Peter Lynch was very right when he said that all the math you need to be successful in the stock market you get in the 5th grade or so.
I incorporate new things when I see them, especially over a period of time if I find that they're working or that I like the results I get. And a lot of the times when I look at these formulas, somebody asks me, hey, do you use this discount model? Or like you said, do you use a dividend discount model? And then half the time I'm not even familiar with the formula. But then when I go look at it, I realize it is something that I'm using just in my head to a certain extent. So, I think all the fundamental numbers that are underneath of the market are important, but I'm not a slave to any sort of outcome of a financial formula.
I agree with you completely. I mean, from my perspective, the dividend discount model is kind of a commingling of a bunch of things that are grounded in common sense. Higher dividend increases are better. You want a company to increase its dividend well into the future. But the problem is that it tends to quantify those aspects with too much precision that we don't really have in reality.
Well, and it changes the price targets too much. I mean, if you're, I'm not good enough to do off the top of my head, but I do know, if you're looking at a company, you think it's going to be a 7% long-term increaser and then it falls down to 5, that's a 2% difference in the dividend increase rate, but that changes the price target by multitudes of that. And so I think, it just, if you're really buying into that, I think you're going to just have a lot of calculations that are more confusing than anything else.
Yeah, definitely. You've self-identified as a dividend growth investor. What's your opinion on share buybacks versus dividend payments or other forms of capital allocation policies?
I'm a big fan of just about any time a company is willing to return cash to me as a shareholder, so long as it's done sustainably. What I mean by that is, as long as I can expect it for the long term and predict it. I need to be able to sort of predict my outcomes, at least, looking out a year or two. So I'm not a big fan of special dividends. I think that's just a waste of capital. I'd much rather them just invest that into the business or just buy back shares at that point in time. I know a lot of people don't like share buybacks, and sometimes it gets a negative light with the whole financial engineering deal. But when you think, as long as the company is able to sustainably increase their dividend, every share that they buy back is saving them their current dividend plus, their dividend growth rate of the future. So it really just helps them to be able to sustainably raise the dividend. So when I'm looking at a company, just cursory at the beginning, reduced share count is one of the 5 or 6 things that I'm looking for.
Are there any companies that stand out to you as being remarkably shareholder friendly in the way that they spend their money?
Yeah, I mean, there's a whole bunch of those. I like it's most of the dividend aristocrats. I'm sure you could say that if management's been that generous for that long, they've obviously prioritized shareholders. Most of the companies that I own are, like I said, I prioritize a rising dividend as well as a reduced share count. That just gets into basic supply and demand principles. I don't want to see a company diluting the shares that I've bought by issuing new ones. But just recently, there's been a ton of companies just giving above average dividend increases. Union Pacific and Visa both just kind of gave investors a double dividend increase, probably due to the tax reform. But they increased on schedule like they usually do, either late last year or early this year, and then they just announced that their upcoming dividends are also going to be increased. So I was impressed by both of those. You don't really see that very often. These companies are usually stick to their schedules pretty close.
When you think of companies that buy back stock, do you think that there's a certain price above which a company should stop repurchasing its shares and a certain price under which a company should be more aggressive in the pace that it buys back its own stock?
Well, I mean, theoretically, you'd love to see a company use valuation during their buyback. That's what I do as an individual investor. But I also, if they're being consistent, you get a company like Apple that's just removing 1% a quarter, or essentially 4% a year or more some years, but just over the long term, you have these companies that are just constantly reducing the share count. And I'm happy if they do that, regardless of what they pay. Just it's sort of like dollar cost averaging. I'm sure these management teams think their stock is cheap at most valuations because they're confident and they understand their business models well. But I'm sure, at 100 times, 50 times earnings, obviously, I would say you shouldn't buy back your stock. But for the most part, I think regular buybacks is pretty similar to just dollar cost averaging that most people think, your Main Street investors should do. So I'm happy to see the corporate guys doing the same thing.
That's interesting. I've actually never heard that comparison before, but it makes a lot of sense.
Yeah, I mean, just like I said, for me, it's all about supply and demand. The companies obviously have huge floats, so it really doesn't make much of a difference for the, 50 or 100 or 200 shares that I own, but it makes you feel good when you know that, your value increased. You didn't do anything. The company just, gave you a little present.
The opposite of a company that repurchases stock is a company that is constantly issuing stock. And the two main categorizations of stocks that do that are REITs and MLPs, because they're always issuing equity to fund these new growth projects or buy new properties or what have you. Given that you like share repurchases so much, what are your thoughts on REITs or MLPs? Do you own them? Would you own them? What are your thoughts?
I do own REITs. I've been out of the energy space for probably 3 or 4 years now. I'm just, I'm not a big, I'd love, I'm just, part of that's almost moral. I'm not a big fan of a lot of the environmental issues surrounding, fossil fuels. So I've just decided I don't need to have exposure to that in my portfolio. But I do understand, those are just completely different business models. So I don't mind seeing them issue shares as long as the moves they make are creative long term. I do own a fair amount of REITs, and I've been buying REITs recently. They're getting, really beaten down. Their yields are, you're seeing yields right now that you haven't seen in years because of the rising interest rates. But a lot of that just comes down to management teams. I buy the blue chip companies because I trust that they have the talent and the know-how to make sure that they're being smart with all their capital maneuvers.
Good to know. Are there any REITs that stand out to you as very attractive long-term investments right now?
Yeah, I mean, there's like I said a whole bunch already before, but I bought Gramercy Property Trust and Realty Income last week. Ventas is looking interesting to me. I bought that years ago, and at one point in time I was up like 40%, and all my gains are gone now. So I'm back near my cost basis on that, and I may add to it. The healthcare space is a little bit. I just worry that regulation will just totally disrupt that and kind of ruin some business models, and that wouldn't really be any fault of the management teams. But I just don't like the risk of the change there. But I like the industrial space. I like the triple net retail space. I'm not a big fan of sort of the shopping mall space. I think Amazon and just in general, I think those big malls are probably going to be dinosaurs here in a decade or so. But I've always wanted to be a landlord myself, but I'm just too lazy and don't like the liquidity of it. And in the town I live, property values are kind of absurdly high because it's a college town. So I've never gone that route, but I'm happy to do it by holding shares of REITs.
Very interesting. Now, your comments about healthcare, about government regulation, does that apply specifically to healthcare REITs, or do you have concerns about the broader healthcare sector, companies like Johnson & Johnson or Abbott Labs or AbbVie?
Well, I have concerns overall. I was buying a ton of healthcare stocks in like 2015, 16 when Hillary Clinton's tweets, and then when we're kind of knocking the market down, and then you had the Gilead News, their legislative oversight in Congress really hurt them a while ago. So at a certain point, I was really overweight in healthcare because I thought that they had been irrationally punished. I've sold out of a lot of those positions since then as sort of values returned. But I worry more in the REIT space just because of some of the things like senior housing and skilled nursing facilities and stuff like that. It's so expensive. I think I read recently that the last 5 years of your life, if you live in these things, cost like $500,000. And, that doesn't seem super sustainable to me. And it seems like some low hanging fruit that the government could go after and or just end subsidies to. So I worry about, people are really happy, sort of bullish on mega healthcare investors right now because its yield is up above 10%. And it's been a great dividend grower recently, but, they're so highly exposed to some industries that I'm worried about that I own shares, but I'm not adding at these, pretty low prices at the moment.
Yeah, Omega's stock has been really hammered because of some issues they're having with one large significant tenant. I think they put them on cash recognition for revenue recognition, and I think that's harmed that stock's price quite a bit.
Yeah, and I guess you just got to worry about that spilling over into the other tenants. I look at a lot, and I don't have these numbers off the top of my head, but what percentage of their revenues are subsidized or not? I think some of them are pretty much 100% private, so I assume that those would be less at risk. But in general, I just you're getting 6.5% to 10% yields there, but you look at Realty Income or National Retail Properties or Store Capital, a lot of these triple net retail plays, and you're getting 5.5% yield. So I'm happy to, lose a percent on my yield there for some perceived safety.
There comes a point when, actually, this is another good question for you. Do you have any kind of due diligence process that helps you determine what's a value trap versus a stock that is actually worth quite a bit more than what it's trading for?
Well, that sort of gets back to the rising top line. When I see a trend of negative sales growth, then sort of the value trap pops up. That signals to me that that company's been disrupted. They're losing market share. They're not a leader in their industry any longer. So I like just sales. I think a lot of dividend growth investors don't, you hear so many times sales don't matter, earnings matters when you're talking about, like the FANG names like Amazon or something. But at the end of the day, if you're not increasing your sales, I think you're going to have a hard time increasing your earnings over the long term. So I look at that. I look at debt levels. I hate seeing companies get over levered, and especially if they're raising that debt to do shareholder returns. And then I just read sort of the analysts, the industry and analysis that the analysts put out. And I found some guys and gals that I trust over the years, their opinions on that. So if they think that a company is losing leadership, I avoid it.
Are there any publications that you'd recommend for our listeners?
Well, yeah, there's several authors on Seeking Alpha that I like. One of the questions you had sent me was, and this kind of gets back to the books I've read, but David Van Knapp has been a big influence on me, especially when I was starting out. He talks a lot about just portfolio management from a business ownership perspective, and I liked that. With the brokerages that I use, I have access to Morningstar, S&P Capital IQ. Morningstar seems to be a lot more conservative than S&P Capital IQ, but I generally sort of weigh those two against each other. I go to Yahoo Finance, where they do a good job of just tracking all the analysts on the street. So I do a lot of just averaging out of opinions, and I'm happy to, if you have 30 people doing something and, you kind of take out the outliers, I assume if they're all relatively similar, I assume that it's, 30 or 25 smart people coming up with a similar answer. I'm happy to side with that.
Very interesting. Good to know. We've talked a lot so far on this call about, how to decide when to buy a stock, what makes a good stock. I kind of want to flip the coin and ask you, are there any serious red flags upon which you would see them and immediately sell a stock?
I look a lot at relative valuation to the market, to the history of that company, and to its peers. So I generally know which are the, in most industries, there's 2 or 3 or 4 leaders or really high quality companies. So, and I usually own all of them. I get bullish on certain areas of the market, and then I'll buy a basket from within that area instead of just trying to pick the one winner or loser. I don't have any sort of illusion that I'm going to be able to do that. But if I've done that and I own 4 or 5 names, and then one of them is, has a valuation that's much higher than the rest, I'll sell that. That just seems like a logical thing to do. And same thing relative to their history. I mean, you see a lot of stocks that, they might trade at 17 or 18 times over like a 20-year average. And, you can also look back and see what their previous highs were. Boeing's an example. That stock's really overvalued right now, and I've considered selling it, but it hasn't ever quite made it up to its historical tops, which I think would be at like $385. So I just look at a lot of relative stuff. And I know people say you can't, you shouldn't drive looking backwards, but over the long term, I think there's just enough data. As long as growth rates and expected growth rates are somewhat similar with what you would expect historically, then the valuation should be in line as well.
So it sounds like you're very valuation focused, which I appreciate, and it kind of aligns with what I try to do. It sounds like you try to identify when stocks are in kind of a little micro bubble, and you'll sell them if that's the case. Is there any sectors of the stock market or other asset classes where you see big bubbles today?
I look at everything sort of on like an individual level. I sold Union Pacific's my favorite railroad, but I sold that back in December, I think at like 126. That was before tax reform. Tax reform sort of changed that equation a little bit, and I regretted it, but I couldn't be sure that was going to happen. So, but anyway, before that, it was just really high above its historical average. And then I'm hoping that some of this weakness allows me to get back into it cheaper. But I have, just as a sector-wide call, I've been selling a lot of my consumer staples recently, as kind of as hard as it is. These are names, household names that, every DGI investor is aware of. But, these guys are trading at 22 to 25 times last year's earnings, or even in some cases next year's earnings. And, they're not growing on the top line. They're being cannibalized by each other and by generic products. And yeah, they have yields in the 3 to 3.5% range, but long term, like we talked about with Comcast and some of these high growth names, if they're only going to give you 3 to 5% annual dividend growth, and in some cases that's generous. We've seen 1 to 3% increases recently. I'm just not interested in owning that. Right now, I would say I guess I'm most bearish on like the consumer staples names. A lot of these slow growth companies that are trading with unjustifiable premiums, in my opinion.
Now, when you say slow or negative growth consumer staples companies, are you thinking of like the Procter and Gamble's and the Colgates and the Coca-Colas, those types of securities?
Yeah, I am. I've sold Procter and Gamble's one that I sold, and that one I sold that at like 89, and I think it was at like 80 the other day. I'm sure today the whole market's up today, but you see that one. I've sold James Smucker. I sold Hershey's recently. I sold Nestle. I think there's a few. I sold Kimberly Clark. And when you're saying these names and you're feeling bad about it, these are sort of the stalwarts in the dividend growth space, or they have been. But moving forward, I think there's a lot of secular trends that are pointing against them. And I'm just at this point, I think if I'm just looking for a yield in that 3% range, I'd rather just own legacy tech than sort of the legacy consumer staples names.
I mean, I think you're definitely right. A lot of those names are very overvalued relative to how much growth they're providing. And I think that there's a lot of investors, particularly self-directed investors, individual investors, who get lulled into a false sense of security because they recognize that those have historically been great businesses. And right now you could even argue that they're still a great business, but they're bad stocks because of the price you have to pay relative to earnings and other fundamental metrics.
Yeah, and I mean, I could be wrong because I'm sure people have said that in the past, and then these companies keep chugging along with like 7 to 10% annual returns. But like you said, they're most of the names that I sold have over a 5-year period of time. They're either flat or negative. Recently, if you look at David Fish's Dividend Aristocrat Champions, Contenders, I forget the third one. It's a CCC list. He does a great job of tracking historical data. He's got 10-year, 5-year, 3-year, and 1-year dividend growth trends within each of those groups. And all three of the groups, the 1-year dividend increase amount is less than the 3-year, which is less than the 5-year, which is less than the 10-year. You're seeing dividend growth rates slow down, and that's especially the case sort of in these old school aristocrats. And I think it's just because they're having a hard time adapting to sort of the new market, a lot of the demographic trends, and just the fact that their products are not as exciting as they used to be.
Are there any old school stocks that do stand out to you for being attractive right now?
I mean, I own Coca-Cola and Pepsi. I've thought about selling them both recently and in the past, but I have such a hard time. I mean, everybody's got to drink to survive. And, I don't think we ought to be drinking sugary sodas and juices and sports drinks as human beings, but I also am not naive to I'm sure that's going to continue. They do taste better, so I'll give those companies that. So they're expensive, but I don't sell them because they have great distribution networks. And then I think they'll just continue to buy sort of hit brands. Kraft Heinz is interesting to me because it has sort of the Berkshire's 3G backing, and you expect that they'll make a big acquisition here soon and sort of grow with the roll-up strategy that a lot of people don't like. But so Kraft Heinz and Anheuser-Busch are sort of unique in that regard. I love, just speaking of Anheuser-Busch, and the alcohol space is so attractive to me long term, but a lot of those names are just really expensive. Constellation and Brown-Forman are two companies I would love to own. I haven't been able to find my spot yet, though.
That's very interesting. I also find the whole 3G Capital, integrate and then cut costs strategy to be quite interesting, and they've been very successful with it in the past. A lot of people argue that it's unsustainable, but I think as long as they can keep finding acquisition candidates, they should do well over the long run. I just want to wrap up by asking you one interesting philosophical question. If you had to sell all your stocks and create a portfolio of 5 or 10 positions right now, what would you buy and why would you buy them?
That is a hard one. It's just so much against my nature to be that concentrated. I don't think I'd sleep at all at night if I had to only own 5 names. However, I will answer the question. Apple would definitely be one of them. If I had to only buy one company, that would be it. And its cash pile more than anything would maybe allow me to sleep at night. I think it gives the company a lot of flexibility. And I know that people think the iPhone is kind of a one-trick pony, but I don't see demand for that going anywhere anytime soon. So, I'd feel comfortable owning Apple. Berkshire Hathaway, I think, would probably be one of them. It's only one company, but it would give me a ton of diversification. doesn't pay a dividend, but you always hear rumors of that changing when Buffett steps down or, God forbid, dies. I guess he's not going to live forever, and I think he's like 84 years old right now. Let's see. I probably would put NVIDIA there. It's pretty speculative, but it's just AI, I think, can be so huge, and I would want exposure to that. In the similar light, I'm not even picking dividend growth companies right now, but if I only had to own 5, I'm looking at companies that they're pretty diversified within themselves and give me exposure to a lot of secular growth trends. So I'd probably put Alphabet there as well. With under their umbrella, they just do so much, from Google to YouTube to Waymo, and a lot of the crazy things they're doing in their speculative bets category. And the 5th company that I would choose, I guess, I would go with Boeing. I think I almost went with Disney there, but I do think they have some issues that I'm a little bit worried about. Boeing, on the other hand, operates in a duopoly, and air travel demand is only going up in a globalized world economy and with urbanization happening. So I think I'd go with Apple, Berkshire, NVIDIA, Alphabet, and Boeing.
That is an excellent list. It was very nice to hear your reasoning behind them. Thanks for sharing. I want to wrap up, Nick, by saying thanks a bunch for being a guest on the podcast today. We're super happy to have you, and we look forward to having you back sometime.
I had fun, and I'd be happy to do it again sometime.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.